dips. If you get these short intermittent dips that perhaps we're seeing today, I mean, you can't really categorize this as a dip, but it's still a almost 400 point fall that you're seeing on the Sensex. Would you advise buying? And if yes, what are the stocks to look at now for a long-term investor?
Afternoon, Sonia. No, yes, again, I think what we've probably seen in terms of the markets climbing a wall of worries, that has been very evident in terms of how stock sectors and the overall index has moved. Again, the global headwinds and the domestic headwinds that Anuj was referring to just a couple of minutes back, that is very well playing out right now. But what you're also seeing in terms of how the earnings have panned out, though on a very low base, I think there is some amount of confidence that if earnings growth comes back very, very strongly in the second half and persists in the next financial year, you're probably going to see the premium valuations probably get justified for the index as a whole. Having said that, I think if the markets do correct both at the index level or sector stock wise, I think it becomes a very good opportunity for long-term investors to probably stagger their way in by buying chunks on any decline that they probably see in the markets. And with that in perspective, what we probably like, as you alluded to, I think a few of these corporate banks like ICICI Bank, where our belief is that the loan growth, specifically in terms of retail advances, have grown at a very fast clip. What they've probably recognized in terms of balance sheet exposure, specifically towards the corporate side of their book, that provisioning might very well continue, both aging related as well as what is probably mandated coming out of NCLT stroke power sector stress. I think the overall book should probably grow and result in the ROEs and ROAs expanding. So I think the corporate banks probably look very, very attractive. We've always remained biased towards private banks, so I think the hold on private banks do continue. Out of the larger universe and within the consumption space per se, our own sense is that auto ancillaries probably still look very, very attractive. And even if you've seen a blip in terms of reported numbers for Maruti, for example, our entire thesis in terms of the fixed cost absorption at their Gujarat plant actually enforcing our thesis of earnings growth actually catching up significantly, with new models still having a huge say in terms of both demand dynamics as well as realizations. I think the volumes should probably sustain going forward. So I think Maruti on any decline probably within the large cap names in the auto universe looks very, very attractive. Cement as a space is something that we remain very, very constructive about, both in terms of expectations of fewer capacities getting added, what you're probably seeing in terms of utilization levels actually inching upwards in the second half because of the spending both in rural and urban affordable housing, infrastructure spending, which has been seen by the front loading of what the government has done, should reap benefits for a few of the companies. So I think large cap companies like Ultratech, ACC should do well in terms of volume-led growth. And within the mid-cap universe, Heidelberg, JK Lakshmi Cement should do well. The broader universe, I think we remain a little bit more selective, Sonia. So I think stocks like music broadcast, for example, where our belief is that the utilization of new stations along with the increase in ad rates should actually prop up top-line growth. They've done the capex for new licenses, and that should probably also entail free cash flows and dividend yields. And Amber Enterprises, where our belief is that because of the unseasonal summer, I think the volume growth should start picking up, reflecting in top-line, bottom-line growth.
Okay, that's